The US just had the worst non-recession year job growth in over a decade. Employers announced over 108,000 layoffs in January, the worst start to a year since 2009. Terrible numbers. But the labor market hasn't crashed. The unemployment rate has stabilized, and we added 130,000 jobs in January. Maybe things aren't so bad after all, right? Wrong. The job market is on the brink. I can prove it to you. And once you see it, you'll be prepared for what's coming. The headline number is the unemployment rate. It's what everyone watches, but it doesn't tell the whole story. Let's start with number of jobs added last year, a fraction of what a healthy economy needs. Job creation hasn't been that bad since the pandemic. According to the Federal Reserve Bank of St. Louis, a normal economy needs about 150,000 new jobs each month to maintain a stable employment rate. We didn't come close. And here's something else most people don't grasp. Last year, the economy grew by 3.8% in Q2 and 4.4% in Q3. Historically, employers create about 260,000 jobs a month with growth like that. The US gained 180,000 jobs for the entire year. Unemployment should have spiked, but it hasn't. The unemployment rate basically sits at the same level as a year ago. But the data hiding underneath that headline tells a completely different story. First, workers themselves are telling you the job market is worse than advertised, not through surveys, through behavior. And here's a signal they don't talk about on the financial news: the quit rate. It measures how many workers voluntarily leave for better opportunities. It's currently just over 2%. We haven't seen quit rates this low since COVID and the Great Recession, and today's quit rate is lower than during the dot-com crisis. Think about what that means. Workers are more reluctant to leave their jobs today than they were during one of the worst economic crises of our lifetime. They aren't leaving because better opportunities don't exist. And here's one reason why. The share of workers saying jobs are hard to find has more than doubled to over 20% in the last few years. At the same time, the share saying jobs are plentiful has collapsed, from around 55% down to about 25%. Workers are telling us the job market is worse than advertised, in behavior and data, not opinion. And it seems the American worker is right. They see the hiring freeze. Job openings fell to 0.87 per unemployed worker early this year, the lowest since COVID. And hiring is slowing. According to the Labor Department, the hires rate, the percent of workers newly hired, was 3.3% in December of last year. For perspective, the hires rate bottomed out just below 3% during the Great Recession in 2008. We're pretty much there today. And here's why that matters more than people realize. When the economy weakens, companies don't start with layoffs. They slow hiring first, then they reduce job openings. Layoffs come last. The hires rate is a leading indicator, and right now it's sitting near Great Recession levels. That's not a healthy economy. That's a warning. So, back to that headline unemployment number. Here are some numbers hiding inside that headline. Numbers they don't talk about on CNBC. Today, more workers are out of work longer than you'd expect. 28% of unemployed workers have been out of a job for 6 months or longer. This indicates structural deterioration. And both of those numbers point to a higher unemployment rate. According to analysis by Bankrate, more than 1 in 4 workers being out of work for 6 months or more correlates with an unemployment rate of around 5.5%. And a hires rate as low as 3.3% tends to happen when unemployment is over 6%. Okay, so the unemployment rate is hovering around 4.2%. It hasn't spiked as some doomsayers have predicted. Why not? Because it's a mirage. Here's the part almost nobody explains, and it's the key to everything. The unemployment rate doesn't measure how many people don't have jobs. It measures the number of people actively looking for a job who can't find one. That means if the pool of people actively looking for work shrinks, the unemployment rate falls, even if nobody gets hired. Right now, the labor pool is contracting. Hard. This, along with long-term unemployment, confirms the structural deterioration. And 3 forces are driving that contraction. Lower labor force participation, baby boomers aging out of the workforce, and a significant decline in foreign-born labor. You'd think a shrinking labor pool would push unemployment down. Fewer people looking, same number of jobs, rate drops. But it hasn't. Why? Because the demand for workers is falling at almost exactly the same rate as the supply. Supply and demand declining in sync. That keeps the headline unemployment rate artificially frozen, even as the actual job market deteriorates underneath it. And here's what that means in real numbers. According to Bankrate, if the labor pool had kept expanding at its 2024 rate, the unemployment rate would already be around 5% or more. But because it's contracting, we only need about 30,000 new jobs per month to keep unemployment from rising. In many economies, 30,000 jobs a month is recessionary. And we managed half that in 2025. That's where we sit, hiring at a recessionary pace behind a headline that's stuck around 4.2%. But don't be fooled, the job market is wobbling and on the verge of collapsing. The headline number is just masking the seriousness of it all. But the underlying numbers tell a different story. Very few new jobs added, very low job openings, a low hires rate, a low quit rate, significant layoffs being announced to start the year. This data points to a very different number, 5.5 to 6%. And that's a number that would be alarming to everyone. That's a number you get in a recession, and the only thing keeping a cap on it is the shrinking pool of workers. The headline number masks what's really happening underneath. People may point to GDP or the stable unemployment rate, but when you peel back the covers, you see it for what it really is. The economy, as measured by the labor market, is in much worse shape than most people think. Here's the uncomfortable truth about where this story ends. Consumer spending is 70% of the US economy. When the real labor market quietly deteriorates behind a stable headline, spending declines. People without jobs don't spend. When spending drops, earnings follow. When earnings fall, markets follow. The pattern is hiding in plain sight. It just hasn't hit the headline number yet. We're at a tipping point, and one or more of these could confirm the pattern and send us over the edge. A substantial increase in layoffs, the hires rate dropping below 3%, a spike in jobless claims. And here's what most people will never hear on the news. The gap between the official number and the real number doesn't close gradually. It corrects fast. And when it does, it shocks everyone who wasn't watching the leading indicators. It's the same setup as 2001 and 2008. 2008. The labor market looked manageable until it didn't. September, Lehman collapses. By December, 533,000 jobs lost in a single month. The worst since 1974. The headline had been masking the pressure for months. 2001? Same pattern. The dot-com collapse had been building for over a year before it showed in the job numbers. When it did, the economy shed 1.7 million jobs over 21 months. The leading indicators were flashing both times. The hires rate, the quit rate, job openings softening. The headline number was the last to know. The pressure was already there. It just hadn't surfaced yet. This isn't scare tactics. This is pattern recognition. The people who read the real data in 2007 positioned before the correction. They built cash. They reduced risk. They watched the leading indicators instead of the headline. And when everyone else panicked, they were ready. Now you know what the headline isn't telling you. The hires rate near Great Recession levels. A quit rate lower than during the dot-com crisis. Job openings at COVID lows. Workers out of work longer. Those point to 5.5 or 6%. The official unemployment rate says 4.2%. The underlying data disagrees. The only question is how long before the headline catches up. None of this is personal financial advice. This is education, so you can build your own plan. If this shifted how you see the current setup, hit subscribe. We publish fresh content multiple times per week, breaking down the economy and helping you grow and protect your wealth, and keep the momentum going. Watch why the stock market hasn't crashed yet, what they don't want you to know. It's on the screen. In the description, you'll find a link for 10% off Alpha Picks. You'll also see a link to my Wealth Builders Blueprint, a large collection of resources you can use to grow your wealth. I also included a link to Zach's Confidential, a more economical alternative to Alpha Picks. Check them out. Thanks for watching. See you on the next one.